Income tax rules in India are one of the most complex laws in the world. There are so many terms and conditions about every other thing that a common man can get confused very easily. I can't teach all of the rules to you in a single course. Forget that I can cover everything in a couple of videos. But still, we all need to know some basic things in law which will help us to make some basic decisions. Let's start with the sources of income. Income tax has divided the sources of income into 5 categories, namely salary, house property, capital gains, business income, and other income. You need to know under which category your income falls, as the tax rates, deductions, and exemptions can be different for different sources. Let's understand some basic things about these income sources. First is income from salary. If you are already a salaried person, then you must have seen a salary slip. If you are not a salaried person, let me tell you what it is. It's a document showing the details of your salary. Your salary consists of the basic amount, dearness allowance, house rent allowance, commissions, bonus, gratuity contribution, provident fund or NPS contribution. There are some more types of allowances as well, which you can see on the screen. Some of these components are tax-free either fully or partially. Apart from the direct money that your employer provides, there are some indirect benefits as well. These are known as perquisites. This can include leave travel concession, gifts from employers, medical treatments, cars, lunch and educational facilities, and some miscellaneous things. The value of these perquisites that you are getting benefits from also forms part of your salary income, and so they are taxed as well. They can be taxed fully or partially depending on the various rules mentioned in the Income Tax Act. So next time you get a salary slip, check out the details very carefully and check if you can save some income tax. The second source is income from house properties. You see, Indians love investing in real estate. So, Income Tax Act has separate rules for taxing income, that is, the rent you get from these properties. The properties you own are divided into 2 types. Self-occupied properties, that is, the properties where you live, and second is rented out properties. As per income tax, you can only 2 self-occupied properties, which means if you have 5 real estate properties and none of them are rented and you are actually using them for your own use, then also as per the income tax rules, you will have to pay the tax on the amount which you could have earned by renting on the remaining 3 properties. Crazy, isn't it? Well, this is derived from the basic philosophy of income tax. In India, we follow the progressive income tax system. That is, more you earn, more wealthy you are, the more contribution you should make towards the society. So if you observe, even the tax rate increases for higher income. Previously, India had wealth tax as well, which is abolished now. Now let's come to the third type of income source, which is capital gains. If you buy any asset from your income and you hold it for some time, then its value either goes up or goes down or might even remain the same. And when you sell that asset, you may get a profit or loss. This profit or loss is a part of your income statement. If it's a profit, then it is called capital gain. And if it is loss, then it is called capital loss. The profit and loss is again divided into 2 types. Short-term gains or losses and long-term gains or losses. Generally, if you sell an asset within 3 years, then it is classified as short-term gain or loss. However, for listed security, the time period is only 1 year. If you sell the asset after 3 years or 1 year, as the case may be, then it is classified under long-term gains or losses. The tax rates are different for short-term and long-term gains. Normally, most of the short-term gains are taxed at your slab rate, and Long-term gains are taxed at 20%. However, for shares, the short-term gain tax rate is 15%. As usual, there are a lot of ifs and buts. You get deduction and indexation benefits in capital gains. But I need to record a separate video to explain these details. The fourth source of income is business and profession. If you are running a business or you are a professional self-employed person like a doctor, lawyer, CA, etc., or maybe even a freelancer doing some gigs, then income from these activities is taxed under this category. Running a business is a task in itself, and one needs to incur a lot of expenditure to earn profits. So it would be unfair to collect the tax on the revenue of the business, because revenue is not a profit itself. So the Income Tax Act has a lot of rules around what qualifies as expenditure to arrive at a profit. After deducting all the allowed expenditures, the profit is calculated and tax is charged on that profit. The last source of income is other income. All other types of income which is not classified under any other sources are taxed under this category. Bank interest is a classic example of income from other sources. There are few rules around which type of expenditure is allowed as deduction from this income. After categorizing your income under various sources and deductions under those categories, the total of all income is known as total income. After calculating total income, you have to check what tax deductible investments and expenditures you have made, which is allowed over and above the deduction specific to the income source. All these deductions are mentioned in Chapter 6 of the Income Tax Act. Hence, they are known as Chapter 6 deductions. Chapter 6 deductions are for individuals as well as companies. But let's stick to individual deductions for the time being. But we will see the details of these deductions in the next video.